Welcome back to Stuff About Money. I'm Xavier Angel, your certified financial planner, and I'm joined today with my co-host, Erik Garcia, certified financial planner. And today is a great day. How are you guys doing today?
Hi,
Great, thank you.
I'm doing well, Xavier.
Hey, you guys are sporting the same haircut there. I've been thinking about doing that.
Well, for those who are listening and not watching, the haircut that he's referring to is the shaved head with the beard. So,
And I haven't had that look since college, so
mm,
I
mhm.
may
Well,
have to
you can
sport
join
it
it. You
later.
can join us. Come on back, Xavier.
Come on back.
I'm thinking about it. So So, Erik, we got a guest today, special
We do.
guest. Who's our guest?
We do. Our guest today is Kevin Caron. Kevin is the co-founder and senior portfolio manager over at Washington Crossing Advisors. I'm sorry, Kevin. We've been working with Kevin and his firm for multiple years here. They're in full transparency. They're one of the managers that we work with our clients, and I wanted to have Kevin on. He's actually been on before, maybe a couple years ago. We may have both had hair on that recording. I'm not
It
sure.
wasn't that long ago, Erik.
But I wanted to have Kevin on to talk a little bit about the investment philosophy that they use in managing their portfolios, and then also just talk a little bit about our present moment that we find ourselves in the economy and kind of what he thinks is going on with not the economy per se, but how what's going on in the world impacts the portfolios, what we should be looking for, and so on and so forth. But before we get into that, Kevin, we have a question for you. What is one
Shoot.
thing about money today that you wish you would have known 20 years ago?
I know that we were able to survive a 20-year period of unbelievable situations in the financial markets. So you had 0% interest rates for a really long time. Just to set the stage, 20 years ago was 2004. So this was before the financial crisis. This was before a decade of 0%, essentially 0%
Hmm.
interest rates or near 0% interest rates. You would have thought that if we were flirting with deflation and a financial crisis and a decade of 0% interest rates, if somebody told me that in 2004, I would have said, wow, we must be in a depression. But lo and behold, here we are, and we're looking at US equity markets at $60 trillion in value. So from the lows of the financial crisis to today, the value of stocks in the United States has gone from roughly $10 trillion to $60 trillion. All of this is would have been unbelievable to hear all of the things that have transpired in the last 20 years if we were sitting back there in 2000. But lo and behold, we've been through an awful lot. And despite it all, the stock market is essentially sitting at record highs. And it's been an unbelievable 20-year period.
That sounds a little bit like when Marty McFly or when Marty went back into the future and got the sports almanac and then Biff got a hold of it and was making bets off the future. So you wish you would have known the future 20 years ago.
Well, not only the future, but if I told you this story in 2004, in 2004, I told you that the financial system was going to collapse, that Lehman Brothers, Bear Stearns, all the way down the line, all those companies were going to disappear, that we were going to have 10 years of emergency 0% interest rates, you would have thought, oh my gosh, we're heading into a financial Armageddon. We must be in the Great Depression. But contrary to that, the stock market is setting at record highs. So I
Yeah.
think we've just been through one of the most extraordinary 20-year periods of financial history. And it'll be interesting to see where we go from here.
The next
You know,
20 will be fun, I'm sure.
yeah, Erik and I were talking earlier. I told Erik, I said, look, why don't you ask me that question? And he said, no. But I was thinking something similar. My thought was, I wish I would have started investing sooner, 20 years ago, because time would have been on my side based off of where we were back in 2004 versus where we are today. Time. Time rewards those staying in the market.
Yeah, absolutely. Absolutely. So, all right, Kevin, let's get into our topic today. A few podcast episodes ago, I had a research analyst for another investment company. We talked about their investment philosophy, momentum investing, which it's technical. They're looking to buy the winners, right? Y'all's philosophy at Washington Crossing is very different. And both philosophies work. Both philosophies have their place. I wanted to highlight just how people think about the stock market, the importance of sticking to a strategy and understanding how portfolio management works. So tell us a little bit. I've tried to name your style of investing, and I really can't think of it other than like quality investing in quality. So if you can, tell us a little bit about y'all's investment philosophy and how you pick stocks.
Sure. The philosophy is simple. I think that by and large, many people overcomplicate investing, and it really doesn't need to be all that complicated. And the best way to think is like a bond investor, even if you're an equity investor, because a bond investor asks two simple questions. The first question is whether or not the bond is going to pay me back. And the second question is whether or not I'm being paid to take on the risk. And I don't see why those same two questions can't be applied to investing in stocks. It's exactly the same thing. You have different companies with different characteristics. Some are more stable, some are more volatile. Some companies have more solid balance sheets with less debt, for example, on the balance sheet. Some companies have more debt and less solid balance sheets. And then some companies are more profitable and some are less. So all we do is we say, okay, we want to own the most durable, flexible, predictable companies, and we're going to call all of that quality. If we can find companies that tick all those boxes, that have very low debt, profitable assets, consistent businesses, then we're going to say, okay, just like a bond investor, that's a quality company, and the stock should behave accordingly. Should have, we would think, generally much less risk than a company that would be low quality. So basically, the first question that we're going to ask is going to say, is the company high quality or not? If it's high quality, then we go for it. And then the second question is going to be, are we well paid to take on the risk? And all we have to do there is apply some very simple financial math. We make an estimate of what we think the company is worth 5 years from now under conservative assumptions. And if we can buy that quality company at a reasonable price, then we think if we put together a portfolio of 30 or 35 of these kind of companies, then we should have a pretty good return, and most importantly, be able to have less risk, which is really important because the world can oftentimes turn out in ways that we don't expect. So we want to be able to make sure that the companies that we own are very solid. And if we do go through a tough time in the future, or things don't turn out as well as they currently seem to be going, that we want to make sure that the companies are going to be able to survive and thrive.
Could you that was a mouthful. That was good. Could you spend a little bit more time and define high quality? I think I know that's you're very objective with it and how y'all pick, but let's break that down and pull that thread a little bit.
Yeah, okay. So we've had to create our own definition of quality here at Washington Crossing, and there are, just a little background on this, there are rating agencies, for example, who will grade companies' credit quality, usually for use by creditors or debt holders. And you can think about Standard & Poor's or Moody's, those kind of rating agencies. And what we discovered in the past was that their definitions of quality don't always square up with what we're looking for. Many of the financial companies that blew up in 2007, 2008, those were rated A, AA, or AAA by Moody's and S&P, or investment grade ratings. So they should have been high quality, but they certainly didn't perform that way, especially from the point of view of an equity investor, as the stocks went to zero. Since we realized that we couldn't rely on the rating agencies to tell us what quality is, we had to come up with our own definition. And if we talk just casually, and we'd say, what's a quality car? What's a quality consumer item? You would generally think that, well, it ought to be something that lasts. So it's something that's durable. It ought to be something that we can depend on. So something that's predictable. And importantly, when things don't go as planned, that there is some flexibility around the company. And so we thought, okay, that to us, if we were describing an automobile, we would want to have those kind of characteristics. So we set to work thinking about how could we define that? And we thought to ourselves, we can certainly look at how much, for durability, for example, we can say how much debt is in the company's capital structure. The financial companies that blew up in the financial crisis, they had very little equity in the companies. They had tremendous amounts of debt. So this is other people's money, basically. And because the stockholder owns the leftovers after all of the creditors and everybody else have been paid, if to the extent that you have a lot of debt in the capital structure, when the assets go down in value, then your equity, your stock value can quickly get wiped out. But we don't want that. We don't want that kind of risk. So we thought to ourselves, what if we took the 1,000 largest companies in the United States and just rank them? The ones with the least debt in the capital structure rise to the top. The ones with the most debt in the capital structure fall to the bottom. And then what if we took those same companies on that measure, for example, and we graded them from A to F? So the A, B, C, D, F, just like school grades. And what if we said, okay, we only want to own the A and B quality companies? So, okay, that would make sense. We could wrap our head around that. And we said, why don't we do the same thing with profitability? But we want to look at the profitability of the assets, because some people will look at the profitability of equity. And without getting too deep into it, the thing that ultimately generates profitability are assets. Equity returns can be engineered, let's say, based upon a lot of other factors, cost of debt and amount of leverage in the balance sheet and so forth. So we just said, okay, let's focus on profitable assets. Okay, fine, do the same thing. And then we just said, okay, let's also look at the company's profits. And the ones that are more stable, we want to let them rise to the top of the list. And the ones that are less stable, maybe commodity companies, let's say, they'll end up at the bottom of the list. So we said, okay, these are really simple metrics. It's just how much debt is in the capital structure, how profitable are the assets, and how consistent are those profits. And if we were able to just amalgamate that all together into one number, we could grade the largest companies in the United States in our way. And then we just wanted to invest only in companies that are A's and B's. We don't want to own C's, D's, and F's. And we thought if we did that, we would likely end up with a group of companies in a portfolio that tends to be more durable, predictable, and flexible. And lo and behold, that's exactly what's happened.
Okay, that's pretty clear. So low debt, profitability. Now, your world of companies that are available to you to buy shrinks because of these metrics. So how do you account for seasons like we've been in where we have high growth? And a lot of these companies that we're seeing drive the markets over the past couple of years, they're big names, but they're not necessarily quality in the way that y'all would define it. So is that just something that you as a firm just like, hey, we might miss out on some of these high growth companies, but we know that the companies that we own are going to outlast? How do you navigate that?
Okay, so no, we didn't miss out on those things. So for example, maybe you're talking about some of the larger tech companies. Large tech companies are actually very high quality. Let's apply the definition I just gave you. Do they tend to have a lot of debt? The answer is no. I think technology overall, the whole sector, has a negligible amount of debt, netting out debt and cash. It's almost non-existent. So that would probably earn a very high grade for many of those companies. Number two, are the assets profitable? Yeah, they're very profitable, those companies. So that wouldn't preclude technology companies from being things that we look at. And then how about consistency? Now, there are some tech companies that can be cyclical, but there are many other technology companies that are much more consistent. And I would say that over the years, from the 80s to the 90s and now up to today, most of those tech companies that had a lot of cyclicality, let's say companies that used to be strongly tied to the business and capital spending cycle, those companies, many times by doing things like embracing the cloud and changing their way that they do business and sell, let's say, software, you've now got companies that are much more consistent. So the only thing that we would have trouble with some of those larger companies that you're talking about would be whether or not the valuations make sense. And if the valuations don't make sense, it's usually because the prices are too high and analysts are assigning very high growth expectations to justify those prices. But if that growth disappoints at any point, that's when those stocks can pull back, and that would give us an opportunity to go out and buy those stocks at better prices.
So that's the second part of your equation. We're looking for durable, consistent, and then at a good price.
Yeah. So the quality, back to the bondholder example, the bondholder, the first question they're going to ask, is the company going to default? Is the company dependable? Is the company high quality? Or is the credit, I should say, high quality? The second question is going to be, okay, now that I've established that this is a high quality bond or a medium quality bond or a low quality bond, what kind of yield does it offer? What kind of spread over treasuries would it offer? So am I being paid as a bondholder to take on the risk? And we're just doing the same exact things with equities. We're just saying, okay, we want to own these durable, flexible, predictable, quality companies. Great. Those are the only ones that we're going to deal with. And then can we find any of those companies at, let's just say, reasonable valuations? And if the answer is yes on both counts, then it goes in the portfolio.
So Kevin,
go ahead, Xavier.
So I was going to ask about interest rate changes when we're in an environment now where we just saw a decrease in the interest rates. When that happens, what's the philosophy towards moving towards fixed income vehicles? Or if you could talk a little bit about that, because I get the question now, should I be going to fixed income? Where should I be as interest rates are coming down?
Okay. So we run a balanced portfolio along with our equity portfolios, but I'll start with an equity answer and then I'll move to a fixed income answer and then give you a full answer. So from an equity investor's perspective, as the interest rates come down, all else being equal, it's going to provide a little bit of buoyancy under the values of the companies that we own. So we might actually find that if everything else stays constant and earnings stay where they are and the economy continues to do well, that we might actually find an opportunity to buy more stocks or make substitutions in cases where stocks may have become more attractive. For the bond investor, we run a bond portfolio here at Washington Crossing, and we essentially same thing. We're going to be looking for quality bonds, and we're going to be looking to ladder them out and be a price taker in corporate bonds is what we tend to deal with here at Washington Crossing. And then what we'll do is when interest rates change, what we're going to do is we're going to roll bonds in a laddered approach. So our shorter term bonds, as they come due, we're going to be taking the proceeds from the maturities and reinvesting them into the long end of in this case, a 10-year bond ladder. And as the yield curve becomes more upwardly properly sloped, that tends to increase the attractiveness of the yield in the portfolio. The long and the short of it is, we have found in bond investing, it's very difficult to be a good forecaster of yields. That's not where we think our strength is. So what we're going to do is we're going to be a price taker, and whatever yield we can get, we're going to accept. And the only place where it gets interesting in the equity world is if bond yields or cash yields get so high that they begin to compete with expected returns on stocks. Because we've had many conversations where we'll say, okay, when rates are rising, we'll get to a point where we'll say, okay, well, the expected return on the stock XYZ really isn't all that high because maybe the stock has gone up. And now you've got yields that are competing against it. That might cause us to shift from stocks into cash or bonds. But now with yields coming down, it's actually going the other way, where we would tend to find greater value in equities. And as the curve becomes more normal, where longer term rates are higher than shorter term rates, the idea of entering a portfolio and rolling bonds off shorter term bonds into longer term bonds makes a lot of sense for people who are looking to get some income.
Thank you.
Yeah, talk a little bit about, going back to y'all's investment philosophy here. One of the things I appreciate about y'all is this is the case with a lot of professional portfolio managers, is just commitment to their investment philosophy. I always say the stock market rewards people who stay committed to a strategy. When people jump from strategy to strategy, philosophy to philosophy, they start to get into a little bit of trouble. Talk a little bit about your style of investing. Where do you find it really performing well, and where do you find it just humming along a little bit, maybe underperforming the market a little bit? Talk a little bit about that and just the human side of it. Do you ever feel like when the market's doing well and y'all are stable but not doing as well as the market, do you ever feel like, oh man, I want to go take a risk? Maybe not with client money, but just your own personal, just the human side.
I don't tend to have those kind of thoughts. I guess we do so much mathematics around here. Everything that our investment committee would have to consider. If you walk into that room and you have an investment idea, you better be able to defend it with the math. And nothing will grind the excitement out of investing as much as sitting down with a pen and paper and doing the mathematics. So so our style, we know what it is. In the proverbial tortoise and hare race, we are clearly the tortoise. We know what we do. We know what we do. We know what we don't do. And our style, because it's so carefully prescribed, all of those things I talked about before about basic criteria that we look for quality, it's very hard for us to deviate from something once you very clearly define what it is you're looking for. And the reason that we're looking for those things is because we believe there's more risk in the world than most people realize. So there are two questions that we have to deal with. Maybe I should have started out with this. The reality is that there is risk and return. And while it's easy to focus on return, we can all picture a price chart or where a performance chart might show something beating the other in terms of return. The more subtle, nuanced, and maybe important thing to try to envision is the degree of risk in an investment. And there are measures that we can use for measuring risk, volatility measures and things like that. But then but risk can come about in strange ways. Before an earthquake, how do you measure an earthquake? Pressure builds up, and then all of a sudden now you have something that has happened that hasn't happened before. So how do you prepare yourselves for risks that may be latent? Or how do you prepare yourself for risks of things like liquidity? So all of a sudden you're an investor and you need to be able to get access to your cash because you need it for something else that's unforeseen. How do you deal with that risk in investing? These are very complex questions. So this is a long way of saying that we have to think about risk and return. And so we deal with risk by focusing on quality. We know what we're looking for, those flexible, durable, predictable kind of companies. We have mathematical measurements that lead us there. And then in the next piece of this, if you come in and present an investment idea, or we're presented with an investment idea, you're going to have to be willing to show the mathematics that answer questions like prove that this company is not risky, prove that this company, whatever growth you're expecting from this company, explain where that comes from. What is that assumption based on? What kind of capital is required in this business? These are all very dry and boring questions, but it cuts through a lot of the noise and emotionalism of this and forces us to make our bets in a very circumspect way. So we know in the end that we are the tortoise, and we have a fairly good understanding that in ebullient markets, we're going to participate but probably lag. But where we're going to make up ground are in flat, grinding, sideways down markets, where the things that we look for really tend to shine. And when you put it all together, the risk-adjusted return should be pretty good. And I would think that by and large, that has been the experience with most of our portfolios.
Talk a little bit more about volatility. You and I were talking the other day about the impact of volatility on portfolios. You talked about the tortoise and the hare. If you can visualize the race between the tortoise and the hare, the tortoise is just steadily moving and the hare is fast and slow and fast and slow and fast and slow. So talk about the impact of volatility on performance.
Yeah, so I'll go back to your analysis. You're in the here and now, the market's going up. If you ask most analysts, say you have XYZ stock, and what's your price target a year from now? And somebody will say, well, stock is trading at 50. My price target a year from now is 70, let's say. Okay. So you could say, okay, that's your return. But that's 1 year. So here's what happens. If you have a company that, let's say the investment goes up 10% in 1 year, and then down 10% the next year, your average return is zero. Mathematically, what's called the arithmetic average of those things is zero. However, what you're going to find is if you go up 10%, so your dollar becomes $1.10, and then you lose 10%, you're going to be a little bit below $1. You're not actually going to be at zero. You're going to be a little below. And it introduces an interesting mathematical wrinkle. It's called geometric returns over time. And to make it more dramatic, if you had a company that was more volatile, that went up, let's say, okay, 50% in 1 year, and then down 50% the next year, we've all heard this. But your arithmetic return would be went up 50, down 50, it's zero. No, it's not. If you go from $1 to $1.50 and you lose half of it, you're at 75 cents. And that's not a 0% return. It's a negative return. What is the difference? If your volatility, if you have a 10% up and down swing, your return is going to be eroded a little bit. So your dollar at the end of that will be worth a little less than $1. But if you have a lot of volatility, you go up 50% and down 50%, you've lost 25%. And that's not a little bit. Baked into the mathematics of returns is volatility. And if you want to improve your returns over time, you can't just look for the hottest stock that's going to generate the highest return this year. What you really need to do is think over time, and you need to drive down the volatility so that you're not constantly going backwards every time the market goes against you. And that's why Washington Crossing focuses on this quality idea. And we were much happier being the tortoise in the tortoise and hare game.
Yeah, that's good. And so definitely need to account for volatility in investing. And what tends to happen is when you have those portfolios that tend to be volatile, and I'm not against having those holdings, and a lot of our clients have some of those holdings in those portfolios, we account for it. But the thing to be careful is when you have increased volatility and you have it on the downside, you're psychologically, you feel like you have to take a bigger risk to make up for it, right? To come back for it. And then you introduce even more risk into a portfolio. So I love how you just described how y'all deal with volatility in that. Xavier, do you have any questions?
I like what you do there, because we are human and we have our inclinations. What we very often will hear when advisors talk to clients, or when we have the opportunity to talk to clients, the idea that you have a foundation of your wealth that is invested in a conservative way is actually very freeing, because it allows you then, some people would say, in a satellite portfolio, let's say, or gives you the opportunity to say, okay, I've put away, let's say, a nice balanced portfolio that is conservatively managed, that's designed to weather a storm. Once you know that, and you've got your sleep at night money tucked away in that way, it then allows you to say, okay, I don't really know what the future is going to bring, and there is something that excites me and I want to invest in. That gives you the ability to go invest in that with a greater sense of equanimity, that if it, for whatever reason, it doesn't work out, it's not going to impair you financially.
I love naming investment portfolios kind of thing. I think when you name something, you give it meaning. So like certain bank accounts and certain investment accounts, I love to have my clients name it. So we have the arcade account. And the arcade account, that's your arcade money, right? Remember as a kid, you go to the arcade with a pocket full of tokens, and you have a fun experience. Maybe you leave with a bunch of tickets and a big teddy bear or some cheap trinkets. Maybe you don't. It's the same thing. Here's your arcade investment account. Maybe you walk away with a ton of money because you picked the right stock. Maybe you don't. It's the experience, but it gives it outlet. And I think part of our job as financial planners is, man, I got to keep you invested. And if you have desires as an investor, yeah, I want to try this, I want to invest in this. I know I need my sleep at night money. I like how you named it. But my dad tells me a story in the early 80s. He went back to college to get his degree, and he took an investment class. And that was right around the time when Chrysler was in bankruptcy. He told his professor that he was thinking about buying Chrysler stock. And he said his professor said that would be the stupidest thing he'd ever do. He'd be wasting his money because the company's going to go out of business. And that was right around the time they came out with the minivan, right? They hired Lee Iacocca, I think, and they came out with the minivan. And his investment would have made not a ton, but at the time he was younger, he'd made some money. And I hear that story, I'm like, man, I never want to be that guy who tells someone that their stock idea is a bad idea. So what we do is we just try to make sure that it's a responsible amount for clients to put into those wild ideas. Xavier, do you have any questions about philosophy before we move maybe a couple minutes into what we're seeing currently in our current environment?
Yeah, not so much as philosophy, but tell me about the team. You talked about the investment committee. What's that look like? Is it 2 guys? Is it 5 individuals? What's that committee look like when you guys are sitting down and talking about what should we put in, what should we pull out?
Sure. So every week we get together, and the committee that works on this portfolio is led by me and my partner, Chad Morganlander. We have an excellent risk manager. His name is Steve Larrett, and he's got probably, his experience dates back to the mid 1980s. Oh, wow. And he's quite a person on the team. He's got a tremendous mathematics background. He was part of a group that helped create an exam called the Financial Risk Management Exam, which is it's a very prestigious exam for people who think about risk a lot in financial markets. He was instrumental in creating at some of the big banks some of the some of the methods for calculating risk at the largest banks around the country, around the world, really. So he's quite an impressive man. We're very lucky to have him on the team. So Steve will be there, and he'll always be chiming in on risk. Then we have two other gentlemen with us, Matthew Battipaglia, his portfolio manager, and his brother, Jeffrey Battipaglia. They are both very fine, very intelligent people who are up and coming and contributing mightily to the effort. And they'll bring in, for example, we'll cover a company in a particular day. We'll have a company come up that looks attractive, and maybe Jeff will come in and he will have a profile that he's written on the company. And he'll walk through what the nature of the company is, some of what the company's seeing in terms of growth, where that growth is coming from, and really dig down and do a deeper dive into that company. We'll discuss it as a team. We'll bring in other members of the team from outside that circle, and we'll land with a decision usually within a couple of days. So it's a good group of people who are very smart that I'm very proud to be associated with. And we've got we just have a good dynamic and a good rhythm. But you better come into that meeting knowing how to defend the investment that we're talking about making, and defend it in a way that's consistent with the principles that Washington Crossing has set out and talked about for years and years.
So there's a lot of challenging going on in there just to make sure that you guys are going in the right direction. And I like that.
Yes. And the other thing too about it is we're not so big that we are bureaucratically and institutionally frozen. I think that you can get to a point where a committee can become so big, you've got a cacophony of voices, and it's very hard to get anything done. I think we've got a very focused group, but a group of very high quality individuals who know what the mission is, and are able to make decisions and get things done.
My wife is a middle school and high school math teacher, and I can't wait to go home to tell her about this recording and how much you brought up math, and for her to share it with her students about, hey, this is a practical application of what you're learning today, or the foundations of what you're learning today. So this is great. Let's move into a little bit about maybe what we're seeing in our current environment, the economy, as it impacts portfolios. I know we had a conversation recently about maybe three specific themes that you're talking a lot about or getting a lot of questions on. Let's run through those maybe in 10 minutes or so and chat on those, and then we'll wrap up.
Sure. All right. So we're in a great spot. The economy is doing very well. A couple of years ago, there was a lot of concern that the Fed raising interest rates was going to dampen the economy and tip it into a recession. It was the end of 2022. The stock market had just gotten beaten up as interest rates rose. Bond investors were reeling from losses. All the macroeconomists were just riveted on the idea that this inverted yield curve was going to lead us inexorably to a recession, and we really need to watch out for some tough times ahead. You couldn't find a bull anywhere at that point in time. We took issue with that. We published a report at the time that talked about the pessimism that was out there. And today we're at the other end of the spectrum. So the bears have pretty much all been excoriated, and they've run for the woods. It's hard to find a bear these days. You've got the U.S. stock market, as I mentioned before, approaching $60 trillion. And then I would say on top of that, you probably got another 10 or $15 trillion in former public companies that are now owned by private equity on top of that. And with an economy that's just under $30 trillion in value, so that's a lot of value to support from a $30 trillion economy. So yes, we have a big and dynamic economy. It's performing well. But the expectations that are built into the stock market today are really pretty optimistic. So to us, this is not a time to let down your guard, even though you can't find bears anymore out there anywhere. And I'm not really saying that we're bearish. I'm just saying that you need to be cognizant of the fact that there are some pretty high expectations that the economy will continue moving forward, that inflation will continue coming down, that the Fed will be able to become more supportive. And if those things don't all come together exactly the right way, we could find ourselves with a more challenging environment for equities ahead. And we just want to make sure that if that ends up being the case, that we're prepared for that. And our answer to that is going to be to focus a lot on, you guessed it, quality.
Quality. So let me throw out some objections. Okay.
Okay.
Yeah, Kevin, I hear you. The economy's doing well. The stock market's at all-time high valuations, but the world is on fire. We have two wars going on in the world. We have uncertainty with presidential election. How is that going to impact taxes? I hear you, man. But how do you respond to that?
Yeah. Our basic argument is that in a portfolio, you have to have an offense and a defense. And where most other managers, I think, tend to lean heavy on the offense side, we lean at least as heavily, if not more, on the defense side. And that's why we have this mantra about quality, durability, flexibility, predictability, all of that. So if the market were to pull back because there's some kind of event that gives us an opportunity, you would want to have a portfolio that is flexible, that can take advantage of those opportunities. And that was exactly the position we found ourselves in, for example, just a few years ago. You've mentioned all things, by the way, that are on the radar, but it's usually things that's not on the radar that become market challenges. At the end of 2019, almost nobody was talking about a thing called COVID, but it very quickly became an issue that the market did not see coming and had to reprice in early 2020. Those investors that were over their skis with a lot of high risk stocks in their portfolio, those were the ones that got hurt the worst. And it was the hardest to hold on to those stocks as they plummeted sharply in value. On the other hand, if you had a portfolio that was focused on more steady kind of performance, yeah, you're down, but you're able to then deploy cash in a more offensive way when the market gives you those opportunities. And so I would say,
when the price, you need to buy that quality when the price is good, right?
Yeah. Correct. And so when those things go bump in the night that you don't expect, then you want to really make sure that you own these high quality things, because that's when you need it the most. When markets are uncertain, when things are happening that are unexpected, what is the reflexive response of just about every market participant? It's to grab for something safe and knowable. And that's what we own every single day. So if something were to happen, I'd say bring it on. In the long run, I think ultimately it will turn into an opportunity, and we're there to harvest it. But we can only do that if we employ a good defense all the way through. And that's what we hope to do by employing a quality-based strategy.
Yeah, and I would add to that, you're talking about the portfolio level, right? For our retail clients, it's own stuff in light of your long-term strategy. Own stuff that you have the capacity to own. If you do have some stuff that are more offensive or portfolios that are more offensive, make sure that you have the capacity for that in terms of time frame or other liquidity. Those are things that are part of the equation in terms of what you own and what you don't own. Xavier, you have any questions before we wrap up here?
I'm good. I'm listening to it, taking it in. Again, like Erik talked about earlier, I'm thinking about the math and playing this for Grace. A practical example for her to look at and see why math is important.
Math makes money.
Yeah, math makes money, and math makes money, and God bless the dryness of math, because it focuses the mind, and I think it helps all of us to think through the issues in a way that tends to maybe override some of our more irrational impulses as human beings. And ultimately, we think that you'll end up making better investment decisions if you just take a minute or two to put pen to paper and do a little bit of math.
Pen to paper, do the math, take a step back. Don't let your emotions take control of this.
Yeah, that right there, I hope people listen to this part all the way to the end, is investing is an objective endeavor. However, it becomes an emotional endeavor, unfortunately. And that's when we get into trouble, is when we put our emotion in front of our investment decision. Man,
I would also just add, we're all engaged in something where if we could know the prices tomorrow, then this would be very easy. We can't know the prices tomorrow. And no matter how much math you do, you can make estimates and try to do the best math you can to estimate what something is ultimately going to be worth. But in the end, the reason you do the math is because it forces you basically to have a discipline that makes you think through basic things in an organized way. Math is a great organizer. So to have some math that leads you through questions like, how risky is this thing that I'm investing in?
Mm-hmm.
What is the potential for growth from this company? How profitable is this company? How much debt is in the capital structure? How much capital do you need to invest in this business? And even if you don't have all of that, if you don't have all of those pieces, just having a structure for thinking through through any kind of question where you're making a choice to slow down and ask those questions is always something that's helpful. So
if you don't have Biff's Sports Almanac predicting the future of stock performance, rely on math. I love it. All right. Yes. Kevin, appreciate you, man. I appreciate our partnership, and I appreciate you and your team. And thank you for taking time this morning.
Appreciate you, Kevin. You have a great day.
Thank you both. Bye.
Awesome.